Come on, S&P 500, I need you to drop 2 more points. Come on, if you drop 2 more points, I'll be a genius. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just signal. So let's be real, you've been staring at a 1 minute chart so long your coffee is already cold. And your eyes are red, and your cat is judging your life choices. You're waiting for the perfect date, right? Well, while you were waiting, the market just moved 5% without you. Welcome to the trap of market timing. What's up, guys? Today we're tackling the heavyweight championship of the investing world. Dollar cost average versus market time. One side promised the perfect entry and maximum gain. The other side is the boring path of consistency. But here's the secret the gurus won't tell you. The boring path is usually the one that actually pays for your retirement. Today we're breaking down why trying to be a hero usually makes you a statistic, and how a system can outperform your intuition 9 times out of 10. Before we dive into the math, drop a comment right now. Are you a team DCA, investing every month no matter what, or a team sniper, waiting for the perfect dick? I want to see the ratios in the comments. What is DCA, the Autopilot strategy? Let's start with the basic for the beginners. Dollar cost average, or DCA, is not a simple magic spell, it's a discipline. Imagine you have $1,200. The market timed wait for a crash that might never come. The DCA investor put in $100 on every first of the month, rain or shine, bulls or bear. When the market is expensive, your $100 buy a little. When the market crashing and everyone is screaming on Twitter, your $100 buy a lot more. You're essentially using volatility as your best friend instead of your worst enemy. The goal here isn't to beat the market in a single day, it's to average down your costs over years. If you ever felt paralyzed because you didn't know if today was a good day to buy, smash that like button. DCA was literally invented to solve your anxiety. The myth of the perfect entry. Now let's talk about market time. It sounds sexy, doesn't it? I'll buy the bottom and sell at the top. Here's the cold hard truth. To time the market perfectly, you have to be right twice. You have to be right about when to get out, and you have to be right when to get back in. Most people get the first part okay because they are scared, but then they sit in cash for 3 years waiting for a bigger crash while the market hits new all-time highs. Have you ever sold a position thinking, oh, it's going lower, only to watch it moon to the next day? Time paying in the comments if you felt that. We all have been there. Why timing is almost impossible. Why timing is so hard? Because of the missing the best day rule. History shows that the market best performance days usually happen within weeks of the worst performing days. You're sitting on the sidelines trying to time the bottom and you miss just the 10 best days of a decade, your total returns can be cut off in half. 10 days out of 365, you aren't playing against a chart, you're playing against a chaotic system that doesn't care about your feelings. There is no bottom bell, nobody rings. You only realize the bottom happening 3 months after it's gone. Discipline versus intuition, the brain trap. This is where market psychology kicks in. Your brain is evolved to run away from lions, not to buy red candles. Intuition tell you to buy when everyone is bragging on TikTok. It's the euphoria. Intuition tells you to sell when the news say the world is ending. It's the fear. DCA is the anti-brain strategy. It removes the human element. If you have a system that say buy on the 15th, you don't have to check the news. You don't have to listen to experts. Just execute. If you're enjoying this dive in, hit that subscribe button and turn on the notification. We're releasing 100 of these videos to turn you into a disciplined beast, and you don't want to miss the next one. The cost of wait cash is trash? A lot of you tell me, but I'm waiting for a 20% correction. Okay, let's do the math. If the market goes up 10% a year for 3 years while you wait for the 20% hit, you already lost. Even if that did happen, the discount price will still be higher than the price was 3 years ago and you start waiting. This is called opportunity cost. Money sitting in a saving account earning 0.1% while inflation is at 4% is money that is slowly melting away. DCA ensures your money is always working. Is it the most profitable strategy in a vertical moonshot? No. But is it the most successful strategy for 99% of humans being with jobs and life? Absolutely. So what's the verdict? If you're a professional high frequency trader with a supercomputer in your basement, go ahead, try to time it. For the rest of us, consistency beats intensity every single time. Stop trying to be a sniper and start being a machine. Set your contribution, forget the noise, and let time do the heavy lifting. To summarize it, DCA reduces the stress. Timings require right twice, which is very rare. Missing the best days ruin your portfolio. Long-term horizons turns volatility into profits. Now I mentioned that your brain is your own worst enemy, but why does the market move so crazy in the first place? In our next video, we're diving into the market psychology, why prices overreact. We're going to talk about collective euphoria, the fear of missing out, FOMO, the chain of reaction, and why the market behaves like a bipolar teenager. You don't want to miss that, because once you understand the psychology, you stop being the victim and start being the one profits. If you enjoyed this content, please hit that like button and subscribe to TradingBits X. We're building a community to decode the economy. And remember, money, markets, we're trading the future. See you in the next one.